Investing can seem daunting, especially for beginners. The financial world is vast and complex, filled with jargon and intricate details that can easily overwhelm anyone new to the scene. You want your money to grow, but the stock market can feel like a roller coaster. The constant ups and downs can be nerve-wracking, making it hard to know when to buy or sell. That's where mutual funds come in. They offer a more stable and manageable way to invest. Think of them as baskets of stocks or bonds managed by professionals. These experts make informed decisions on your behalf, aiming to maximize returns while minimizing risks. When you invest in a mutual fund, you're pooling your money with other investors. This collective investment approach allows for greater purchasing power and diversification. This allows you to access a diversified portfolio even with a small amount of money. Diversification helps spread risk, so you're not putting all your eggs in one basket. It's like having a team of experts working for you. They continuously monitor the market and adjust the fund's holdings to align with its investment goals. Mutual funds offer a simple and effective way to participate in the growth of the market. Over time, a well-managed mutual fund can provide substantial returns. They are perfect for those who don't have the time or expertise to pick individual stocks. You can invest with peace of mind, knowing that your money is in capable hands. With mutual funds, you can start your investment journey with confidence. Whether you're saving for retirement, a home, or your child's education, mutual funds can help you reach your financial goals. Let's explore the world of mutual funds together and unlock the potential for financial growth. Understanding how they work can empower you to make informed investment decisions. Ready to embark on this exciting adventure? Join us as we dive deeper into the benefits and opportunities that mutual funds offer. Why are mutual funds so popular? Let's break down their advantages. Firstly, they offer instant diversification. Instead of putting all your eggs in one basket, mutual funds spread your risk across various assets. Secondly, professional fund managers handle your investments. These experts research, analyze, and make informed decisions on your behalf. Thirdly, mutual funds are highly affordable. You can start investing with small amounts, making it accessible to everyone. Lastly, they are highly liquid, meaning you can easily buy or sell units based on your financial needs. With these benefits, mutual funds provide a convenient and efficient way to grow your wealth over time. They empower you to participate in the market and achieve your financial goals. Just like there are different types of cars, mutual funds come in various flavors. Understanding these categories is crucial for choosing the right fund for you. Equity funds invest primarily in stocks, aiming for high returns but with higher risk. Debt funds, on the other hand, invest in bonds and government securities, offering stability but with moderate returns. Hybrid funds combine the best of both worlds, investing in both stocks and bonds for a balanced approach. Within these broad categories, you'll find specialized funds like sector funds, index funds, and tax-saving funds. Each serves a specific investment objective and risk appetite. Understanding the different types of mutual funds helps you align your investments with your financial goals and risk tolerance. It's about finding the right tool for the job. With so many options available, selecting the right mutual fund can feel overwhelming. The sheer variety can make it difficult to know where to start. Don't worry, we'll simplify it for you. By breaking down the process into manageable steps, you can make an informed decision with confidence. Start by defining your investment goals. Knowing what you want to achieve is the first step in narrowing down your options. Are you saving for retirement, a down payment on a house, or your child's education? Each goal may require a different investment strategy. Next, assess your risk tolerance. Understanding how much risk you are willing to take is crucial in selecting the right fund. Are you comfortable with market fluctuations, or do you prefer a more conservative approach? Your comfort level with risk will guide your choices. Once you know your goals and risk appetite, look at the fund's track record. A fund's history can tell you a lot about its potential. Past performance is not a guarantee of future returns, but it provides valuable insights into the fund manager's consistency and expertise. Consistent performance over time can be a good indicator of reliability. Also, consider the expense ratio, which is the annual fee charged by the fund. High fees can eat into your returns over time. Lower expense ratios mean more of your money is working for you. This can significantly impact your overall returns, especially in the long run. Remember, choosing a mutual fund is not a one-size-fits-all approach. Each investor has unique needs and preferences. It's about finding the perfect match for your individual needs and financial aspirations. Take your time, do your research, and choose wisely. Section 5. HDFC Equity Fund, a case study. Let's take a real-life example to understand how to evaluate a mutual fund. HDFC Equity Fund is a popular choice among investors. This fund invests primarily in large-cap companies, which are well-established and financially sound businesses. It has a long track record of delivering consistent returns, making it suitable for long-term investors. The fund manager follows a growth-oriented investment style, focusing on companies with strong earnings potential and a competitive edge. They conduct thorough research and analysis to identify promising investment opportunities. However, it's important to note that past performance is not indicative of future results. The market is dynamic, and returns can fluctuate. Before investing, it's crucial to read the scheme-related documents carefully and consult with a financial advisor. Section 6. Decoding the charts. Technical analysis explained. Technical analysis is like reading the language of charts. It involves studying historical price patterns and trading volumes to predict future price movements. Traders use various tools like moving averages, support and resistance levels, and candlestick patterns to identify trends and potential buying or selling opportunities. For instance, a moving average is a line that smooths out price fluctuations over a specific period. When the price crosses above the moving average, it can signal a bullish trend, and when it crosses below, it can indicate a bearish trend. Technical analysis is a complex subject, and it's essential to learn from reputable sources and practice before making trading decisions based solely on technical indicators. Section 7. Looking under the hood. Fundamental analysis of mutual funds. Fundamental analysis focuses on the intrinsic value of a company or a mutual fund. It involves examining financial statements, industry trends, management quality, and other factors to determine if an investment is undervalued or overvalued. Key financial ratios used in fundamental analysis include price-to-earnings ratio, price-to-book ratio, and return on equity. These ratios provide insights into a company's profitability, asset utilization, and management efficiency. For mutual funds, fundamental analysis also involves evaluating the fund manager's track record, investment philosophy, and portfolio holdings. By combining technical and fundamental analysis, investors can make more informed investment decisions based on both market sentiment and the underlying value of their investments. Section 8. Taking the plunge. How to invest in mutual funds. Ready to start investing? Let's dive into the steps you need to follow to make your first investment in mutual funds. The process is simpler than you might think. With a few straightforward steps, you can be on your way to becoming an investor. First, complete your Know Your Customer formalities. This is a mandatory step to ensure the authenticity of your identity. This involves verifying your identity and address proof as per regulatory requirements. You'll need documents like your passport, utility bill, or any other government-issued ID. Once your KYC is done, you can choose your preferred investment method. It's important to consider your financial goals and risk tolerance. You can invest in mutual funds through a systematic investment plan or a lump sum investment. Each method has its own benefits and can be chosen based on your financial strategy. SIP allows you to invest a fixed amount regularly, automating your investments and averaging out your purchase price over time. This method is great for disciplined investors who prefer consistency. Lump sum investment, on the other hand, involves investing a significant amount at once. This can be beneficial if you have a large sum of money ready to invest. You can invest in mutual funds online through various platforms or offline through distributors and banks. Online platforms offer convenience and ease of access, while offline methods provide personalized assistance. Choose a method that suits your convenience and investment preferences. Whether you prefer the digital route or face-to-face interaction, the choice is yours. Happy investing. Section 9. Your journey to financial freedom begins now. Investing in mutual funds is a journey, not a sprint. It's about making informed decisions, staying disciplined, and being patient with your investments. Remember to diversify your portfolio, review your investments periodically, and rebalance when necessary to align with your financial goals. Investing doesn't have to be complicated. With the right knowledge and guidance, you can make your money work for you and achieve your financial aspirations. Start your investment journey today and unlock the potential for a brighter financial future.